Think about everything you learned in school. You learned how to solve for X. You learned the causes of wars that ended before your grandparents were born. You learned the parts of a plant cell, the periodic table, the themes of novels written in centuries you will never inhabit. Someone decided all of that was essential and you needed to know it. And then you turned 18 and walked into the world, and the world handed you a credit card application, a student loan agreement, a lease, a tax form, a retirement account you had to set up yourself. And nobody had ever explained any of it. Not once. Not in a single class. That is not an accident. The reason you were never taught how money actually works is not because the information is too complicated. It is not because educators forgot. It is because the systems that money flows through were not built to be understood by the people money flows from. They were built to extract value from people who don't know the rules. And the single most effective way to keep that system running is to make sure the people at the bottom of it never learn how it works. This is the story of how that happened, why it still works, and what the actual rules are. Let's start at the beginning. Money, in the form most people interact with it today, is not a thing. It is a relationship. It is a promise. When you hold a dollar, you are not holding stored value the way you might hold a gold coin or a piece of land. You are holding a note, a claim, that says this piece of paper represents a unit of account that other people have agreed to accept in exchange for goods and services. The dollar has value because people believe it has value. And people believe it has value because the government that issues it requires you to pay your taxes in it. That's it. That is the foundation. Most people were never told this. Most people go their entire lives believing that money is a fixed thing, that there is a certain amount of it in the world, that some people have more and some people have less, and the goal is simply to get more of your share. But that is not how money works. Money is created out of thin air. Banks create it to lend to you. The Federal Reserve, a private institution, creates it to lend to the government. The supply of money is not fixed. It expands and contracts, and the people who understand this have a fundamentally different relationship with money than the people who don't. Here is the most important thing almost no one learns in school. There are two kinds of income. The first kind is what most people have, and it is called earned income. You trade your time for money, you work an hour, you get paid for an hour. You stop working, you stop getting paid. This is the income that gets taxed at the highest rates. In the United States, earned income can be taxed at rates approaching 40% for higher earners. It is the income of employees and freelancers and small business owners. The second kind is called passive income. This is money that makes more money without requiring your time. Dividends from stocks, rent from property, interest from bonds, royalties from intellectual property, capital gains from investments. This income is taxed at significantly lower rates. Long-term capital gains in the United States are taxed at a maximum of 20%, and for many earners, much less. The wealthiest individuals in the country earn most of their income from this second category. The person who works 60 hours a week as a doctor pays a higher tax rate on their income than the person who holds a large portfolio of dividend-paying stocks and does nothing. That is not a conspiracy. That is the written, legal, publicly available tax code, and it is the code that almost nobody in school ever showed you. Economist Emmanuel Saez at the University of California, Berkeley, has spent decades studying income and wealth distribution. His research, which draws on decades of tax return data, shows that the share of income going to the top 1% has more than doubled since the 1970s. Not because those individuals became dramatically more productive, but because the rules of the game were changed in ways that concentrated the returns to capital rather than labor. And the people affected most by those changes were the ones who didn't know the rules had changed. Now let's talk about debt. You were probably taught that debt is bad, that borrowing money means you failed to save enough, that carrying a balance on a credit card is a personal moral failure, that the goal is to be debt-free. The wealthy were taught something different. The wealthy were taught that debt is a tool, that borrowed money can be used to acquire assets that generate more income than the interest costs, that in an inflationary environment, borrowing at a fixed interest rate means you are paying back the loan with money that is worth less than the money you borrowed, That the tax code allows you to deduct the interest on business loans and investment property mortgages, making borrowing even cheaper in after-tax terms. A person who borrows money to buy a rental property, collects rent that covers the mortgage, and watches the property appreciate in value over 20 years has used debt to build wealth. A person who borrows money on a credit card at 22% interest to buy groceries is being destroyed by debt. Both of these people are using debt, but they are using it in entirely different ways, and almost no one ever explained the difference. Robert Kiyosaki, in his widely read work on financial education, drew a distinction between assets and liabilities that almost no school curriculum had ever bothered to formalize. His framing was simple. An asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. A car is a liability. A house you live in is closer to a liability than an asset because it costs you money every month and generates no income. A rental property that generates more income than it costs is an asset. A business that runs without your constant presence is an asset. The goal, in his framing, is to accumulate assets, not possessions. Most people were never given this framework. They were told to work hard, spend less than they earn, and save. That advice is not wrong, but it is radically incomplete. It is advice optimized for a world where the rules of money never change, and the rules of money change constantly. Economist Thomas Piketty's landmark research showed that when the rate of return on capital exceeds the rate of economic growth, wealth automatically concentrates at the top. His formula, expressed simply, is that money invested grows faster than wages rise, which means that over time, in a capitalist economy, the gap between people who own assets and people who work for wages tends to widen automatically, without anyone doing anything illegal or even particularly unfair. It is simply the mathematics of compound returns, applied to a system where capital and labor are compensated differently. Nobody taught you this in school because this is not information that makes you a better worker. It is information that makes you harder to exploit as one. There is also the question of inflation, which may be the most quietly devastating economic force in most people's lives, and which most people understand only vaguely. When prices rise, the money sitting in your savings account loses purchasing power. $1 saved today buys less next year than it does right now. This is not a bug in the system. It is a feature. Inflation incentivizes spending and investment. It discourages hoarding cash. Central banks deliberately target a rate of inflation, typically around 2% per year, in developed economies, because a predictable, low level of inflation is considered healthy for economic activity. Massive and irresponsible government spending, on the other hand, tends to trigger runaway inflation, leading to catastrophic effects. But what this means for the average person who was told to save money is that keeping your money in a savings account, which typically earns interest below the rate of inflation, means you are slowly losing wealth every year, even as your account balance grows. You are running in place on a treadmill that is moving backward. The people who understand inflation own assets that appreciate with or faster than inflation. Real estate, stocks, commodities. They understand that the goal is not to save money. The goal is to deploy money into things that grow. Saving is a starting point. It is not a destination. Federal Reserve research has found that the bottom 50% of American households by wealth hold almost no financial assets beyond a checking or savings account, and perhaps a modest retirement plan. The top 10% hold the vast majority of stocks, real estate, and business equity. When asset prices rise, as they tend to do over long periods, the people who hold assets benefit. The people who hold cash or near cash equivalents fall further behind. And here's the part that almost nobody says out loud. The people who designed the modern financial system were not thinking about you when they designed it. The mortgage interest deduction benefits people who own homes, not people who rent. The capital gains tax rate benefits people who own investments, not people who earn wages. The 401k system, which replaced pensions in most of the private sector, transferred the risk of retirement funding from employers to employees, and then required those employees to make investment decisions that most of them had never been trained to make. These were not random outcomes. They were policy choices. And the institutions that lobbied for those policy choices were not the ones sitting at the bottom of the income distribution. Financial journalist Helene Olin, in her research on the personal finance industry, has pointed out that the explosion of personal finance advice, the books, the podcasts, the courses, the seminars, the influencers, coincided almost perfectly with the period in which wages stagnated, pensions disappeared, and the cost of healthcare, housing, and education rose dramatically faster than inflation. The advice industry grew up to fill a gap that policy had created. And while some of that advice is genuinely useful, much of it places the entire burden of financial survival on individual behavior. And almost none of it addresses the structural conditions that make financial survival so difficult in the first place. You were never taught how money works because the system runs more smoothly when you don't know. But now you know some of it. Money is a promise, not a thing. Earned income and passive income are taxed differently, and the wealthy live in the second category. Debt is a tool, and the difference between wealth-building debt and wealth-destroying debt is not the debt itself, but what it buys. Inflation silently erodes savings, and the response to inflation is to own assets that grow. Compound returns mean that time in the market is more valuable than almost any other financial variable. And the rules of the financial system were written by people with assets, for people with assets, in a language that was never designed to be taught in schools. None of this means the game is unwinnable. It means you have been playing without knowing the rules. Now you know the rules. The next move is yours. If you found this information helpful, please like, subscribe, and comment below how this information made a difference for you.